The market is bleeding red. Look at the monitors. Every ticker is flashing downward, a relentless cascade of crimson that has wiped out years of gains in a single morning. Consumer confidence is cratered, hitting a decade low that echoes through every trading floor. The air in the room feels thin, charged with the static of 1,000 simultaneous losses. You watch the numbers tumble, each percentage point drop a physical blow to the portfolios of millions. It is a total wipeout. Panic is the only currency left. But stop. Look past the flashing red lights. While the herd reacts to the noise, the smart money is watching the floor. This is not just a collapse. It is a structural reset. The carnage you see on the screen is the exact environment where real opportunity hides. Most people see a burning building and run for the street. We see a foundation that is still standing. We are not here to watch the fire. We are here to sift through the debris, because the deeper the market sinks, the more valuable the survivors become. The panic is temporary. The value is permanent. Let us start the hunt. Now, turn your eyes to the crowd. It is a stampede. Investors are sprinting for the exits, their movements frantic, uncoordinated, and driven by pure, unfiltered fear. They are not selling. They are purging. They treat retail stocks like radioactive waste, dumping shares at any price just to get the weight off their hands. Watch the volume spikes. It is a fire sale, where the participants are paying the buyer to take the goods away. They see the red on the screen, and their instinct overrides every shred of logic. They are liquidating long-term holdings to sit in cash, convinced that the floor is about to drop out of the entire economy. It is a feedback loop of misery. One trader panics, 3 more follow. And within minutes, 1,000 sell orders hit the exchange simultaneously. They are clearing the shelves, leaving behind a vacuum of liquidity. They think they are escaping a sinking ship. They do not realize they are throwing away the very assets that will define the next decade of growth. The exits are jammed, the air is thick with desperation, and the market is being stripped bare. Let them run. Every share they discard in a blind frenzy is a piece of the puzzle we are about to assemble. The stampede has passed. The screens are still red, but the frantic energy of the crowd has faded into a dull, rhythmic pulse of data. Now, silence. This is the moment where the noise dies down and the real work begins. Most people are still staring at the exit signs, their hands shaking as they log out of their accounts. They see a graveyard. You need to see a blueprint. To find the gold, you have to stop looking at the fire and start looking at the structure. It requires a complete recalibration of your vision. You are no longer a participant in the panic. You are an observer of the wreckage. You walk through the debris, not to mourn what was lost, but to identify what remains intact. Ask yourself, what is the difference between a business that is dying and a business that is simply on sale? The answer lies in the disconnect between price and utility. The market is currently pricing everything as if the world is ending tomorrow, but the world is not ending. It is just shifting. By stripping away the emotional weight of the red tickers, you begin to see the architecture of the market for what it truly is, a landscape of mispriced assets waiting for a steady hand. Now, we hunt. We are not looking for the flashy, high-growth tech stocks that everyone chases when the sun is out. We are looking for the sticky. Think about the average shopper standing in a grocery aisle. They wince at the price of a latte. They put the premium coffee back on the shelf. They cut the streaming services. They trim the fat. But then, they walk to the pet aisle. They pick up the dog food. They do not check the price. They do not look for a discount. They put it in the cart because that is not an option, it is a requirement. This is the behavior we are tracking. A sticky company is one that sits at the center of a consumer's non-negotiable life. When wallets are slammed shut, the spending does not stop. It just migrates. It moves away from the discretionary and settles into the essential. We are looking for the businesses that act as a utility in the household budget. If a company provides a service that a customer will pay for even when they are cutting their own meals, you have found a fortress. These are the companies that do not just survive a recession. They thrive in the vacuum left by the companies that failed. We are not buying stocks. We are buying the habits that people cannot break. Let us examine the engine behind this resilience. Take a company like Chewy. They do not just sell a bag of kibble, they build a flywheel. It starts with the initial transaction, but that is merely the spark. The real power lies in the subscription. Once a customer enters their ecosystem, the data loop begins. The company learns the breed, the age, and the specific dietary needs of the pet. They predict the depletion rate of the food. They automate the delivery before the bowl is empty. This is not just convenience. It is a structural lock. The customer stops searching for alternatives because the friction of switching is too high. Why look elsewhere when the solution arrives at your door with surgical precision? Every repeat order feeds more data into the system, refining the logistics and tightening the bond. The flywheel gains momentum with every cycle, making the customer base increasingly difficult for competitors to poach. In a market where trust is scarce, this operational intimacy becomes a fortress. They have turned a commodity product into a recurring utility. This is the mechanical advantage that keeps the revenue flowing while the rest of the retail sector is busy bleeding out. The true genius of this model is the removal of the decision-making process. When a sale is a one-time event, the company must fight for the customer's attention every single month. They must compete on price, on display, and on convenience. But when you shift that relationship to a subscription, the dynamic changes entirely. You are no longer selling a product. You are providing a service that runs in the background of the customer's life. The recurring revenue creates a predictable baseline. Think about the operational stability this provides. While other retailers scramble to clear their inventory during a downturn, these companies operate with a clear line of sight. They know exactly how many units will move next month because the orders are already locked in the system. This is the transition from a volatile retail play to a defensive asset. The subscription acts as a buffer against economic shocks. It turns the customer into a permanent stakeholder in the business's success. By automating the replenishment, the company effectively becomes a utility, as essential as water or electricity. This is the bedrock of long-term value. We are betting on the stability of the recurring cycle, not the fluctuations of the daily ticker. Now, look beyond the spreadsheets and the automated logistics. Why does this model hold up when the economy hits a wall? It comes down to a hard, visceral truth about the modern consumer. In a recession, the average household begins to prune their expenses with ruthless efficiency. They cut the streaming services, they stop dining out, and they swap premium brands for generic alternatives. But watch what happens when they get to the pet aisle. The behavior changes. The logic shifts. A pet owner will skip their own lunch. They will delay a necessary repair, and they will sacrifice their own comfort before they let their dog go hungry. This is not a luxury purchase anymore. It is a moral obligation. The pet has become a member of the family, and that bond is immune to the fluctuations of the stock market. This is the ultimate stickiness. It is not driven by convenience or software. It is driven by a deep-seated emotional priority that overrides financial caution. When you identify a company at the center of this relationship, you have found an asset that is recession-proof. That is the bedrock of our conviction. Now, pivot your focus from the digital subscription loop to the physical ground game. While e-commerce giants rely on data algorithms to lock in the consumer, there exists a completely different breed of retailer designed for the trenches of a downturn. Think of these as the defensive fortresses of the market. We are talking about the deep discounters. Their business model does not require a high-tech interface or a recurring software prompt to stay relevant. Instead, they operate on a fundamental principle of necessity and physical proximity. When the broader market begins to fracture, these companies do not need to pivot their strategy. They are already positioned exactly where the consumer is forced to go. They are the bedrock of the retail sector precisely because they provide the most basic, non-discretionary goods at the lowest possible price point. While other businesses struggle, the deep discounter thrives. You are betting on the reality that the need for basic staples remains absolute. Track the movement of the average household budget. When inflation bites, the math changes instantly. The middle class, once comfortable with premium grocers and brand-name loyalty, suddenly faces a wall of rising costs. Watch the behavior shift in real time. They do not just cut back on luxuries. They begin a systematic migration downward. They walk past the familiar aisles of high-end retailers, checking prices, wincing, and ultimately turning away. This is not a choice made out of preference. It is a forced adaptation to economic reality. They start filling their carts at the dollar store, seeking the same essential goods at a fraction of the cost. This is a massive, structural movement of capital. As the middle class retreats from the premium sector, they pour their remaining purchasing power into deep discount retailers. The dollar store becomes the new primary destination for the household. It is a migration of necessity. Stop viewing these companies as mere retailers. Start viewing them as utilities. In the same way a city relies on a power grid to keep the lights on, the economy relies on these stores to keep the household running. They are not subject to the whims of consumer trends or the cyclical nature of luxury spending. They are the infrastructure of survival. When the market enters a period of severe contraction, the demand for these services does not fluctuate. It stabilizes. Think of the business model as a low-voltage, high-consistency current. Every transaction is a small, necessary pulse that keeps the system alive. While other sectors experience massive outages when capital dries up, these retailers maintain a steady, predictable flow of revenue. They are not chasing the growth of a bull market. They are capturing the absolute baseline of human consumption. This is the definition of a recession-proof play. When the broader market is in free fall, these companies act as the floor. You are not buying a shop. You are buying a stake in the fundamental machinery of daily life. Now, look at the screen. The market is screaming, but the numbers tell a different story. We are hunting for the high-quality names, the ones that have been dragged down by the general panic, not by their own performance. Focus on the price-to-earnings multiples. We are looking for the 5-year floor. When a company with a proven, sticky business model trades at its lowest multiple in half a decade, the market is mispricing reality. The crowd is selling because they are afraid of the headline, not the balance sheet. They see the red on the ticker and assume the business is dying. But you are looking at the underlying growth, the recurring revenue, and the essential nature of the product. You are watching the gap between the current, depressed price and the historical average. This is the tension of the bottom. Every tick downward in price is a signal, not a warning. You are not just watching the market. You are measuring the distance between panic and potential. The urge will hit you. It is a sharp physical pull in your gut. You see the price drop. You see the value. And your brain screams to dump every dollar you have into the market right now. Stop. That impulse is the trap. The market is designed to capitalize on that exact moment of desperation. If you go all in, you are not investing. You are gambling on a single point in time. You are trying to catch a falling knife with both hands. The discipline here is not in the buying, it is in the restraint. You must force yourself to stand back while the crowd panics. We do not chase the bottom, we build a foundation. We are going to nibble. We take a small position, then we wait. By refusing the temptation to commit everything at once, you protect yourself from the volatility that destroys the impatient. You are the predator here, and predators do not rush their kill. You wait, you measure, and you strike only when the risk is managed. Now, the real work begins. You sit in the silence, eyes locked on the ticker, waiting for the blood to hit the water. The market is a living thing, and it has a rhythm to its panic. You are looking for the spikes, those sudden vertical drops where the algorithms lose their minds, and the retail crowd hits the sell button in a blind frenzy. It is not about guessing the bottom. It is about recognizing the climax of the fear. You watch the volume bars climb, a jagged mountain of red on your screen. Each spike is a gift. It is the sound of weak hands breaking under pressure. You feel the tension tighten in your chest, but you do not blink. You are not here to participate in the chaos. You are here to harvest it. When the price dips into that predetermined zone, you do not hesitate. You are ready to execute. The air in the room feels heavy. You are the predator waiting for the prey to stumble. The spike is coming, and when it hits, you will be the one holding the line. There it is. The volume explodes. A massive red candle tears through the support level, and the screen flashes a warning of extreme volatility. This is the moment. The crowd is liquidating, dumping shares in a blind rush to salvage what remains. Your heart rate stays steady. You do not look at the news feeds or the panic-stricken headlines. You look at the order book. You click the buy button. The first tranche is gone. You have just purchased quality assets while the rest of the world is throwing them away. The trade confirmation pops up. A small, static box against the chaos of the scrolling red numbers. It is done. You own a piece of the business at a price that would have been impossible yesterday. The market continues to scream, the numbers dropping further, but you do not flinch. You have successfully breached the wall of fear. You are no longer watching the carnage. You are building your position within it. The first nibble is complete, and the cost basis is locked in. You watch the ticker, waiting for the next tremor. The panic is their problem. The opportunity is yours. The market does not stop at the first dip. It accelerates. The red numbers cascade down the screen, a waterfall of liquidation that would terrify the uninitiated. You watch the price-to-earnings multiples compress, hitting levels not seen in half a decade. This is not a mistake. It is a clearance sale. You move to the second tranche. You are not guessing, you are calculating. You place the order, and the system executes with cold, mechanical precision. The shares fill your account, adding weight to your position. The broader market is still sprinting for the exits, convinced the sky is falling, but you are looking at the fundamentals. The essential nature of these companies remains untouched by the panic. You see the data loop, the recurring revenue, and the defensive moat of the discount retailers holding firm. You deploy the third tranche as the selling intensifies. Every downward tick of the ticker is a discount you are harvesting. You are not fighting the current. You are using it to build a foundation that will stand long after the dust settles. The carnage on the screen is merely the backdrop for your accumulation. You have successfully turned the panic into a systematic wealth-building event. The portfolio grows, the cost basis drops, and you remain the only calm observer in a room full of chaos. The final wave of selling is losing its momentum. You watch the ticker, noting the gaps between trades widening, a clear sign that the panic is running out of fuel. This is the final window. You execute the last, largest tranche of your plan. The order hits the exchange, and the shares are absorbed into your account. Your cost basis is now locked at a level. That will be the envy of the street when the cycle turns. You look at the screen one last time. The red is still there, but it no longer carries the weight of a threat. It is simply a record of the opportunity you have just seized. The market is quiet now, hovering in a state of exhaustion, waiting for the next catalyst. You have finished the work. Every position is built, every discount harvested, and every fundamental metric aligned with your long-term thesis. The broader market remains blinded by the debris, still convinced that the floor is falling out. They are wrong. The silence on the screen breaks. It starts with a single, massive buy order that rips through the sell-side liquidity, leaving a gap in the order book. The ticker flashes green for the first time in weeks. It is not a fluke. Another order follows, then another, as the algorithms detect the shift in momentum. The broader market finally wakes up. The realization hits the floor like a physical shockwave. Analysts scramble to reevaluate the very companies they were dumping only hours ago. They see the subscription numbers, the recurring revenue, and the resilience of the discount retailers. The panic that defined the last month evaporates, replaced by a frantic scramble to buy back in. You watch the price action turn from a slow crawl to a vertical climb. The red numbers are being erased, replaced by a steady, aggressive green. The market is no longer looking for the exit. It is fighting for a seat at the table. The valuation gap you exploited is closing rapidly, and the sticky businesses you secured are now the leaders of the recovery. The shift is complete. The fear is gone. Look back at the carnage that defined the start of this cycle. The retail sector was labeled a graveyard, a place where capital went to die under the weight of panic and uncertainty. Investors fled, dumping shares into the void, convinced that the end was near. They saw only debris and loss. You saw something else entirely. You saw the structural integrity of companies that thrive on necessity, the sticky models that hold value even when the economy contracts. Now, as the dust settles and the market climbs, the true nature of that rubble is undeniable. It was never a graveyard. It was a gold mine, waiting for someone to look past the surface-level fear. You sifted through the wreckage while others were running for the doors. You identified the high-quality assets that were mispriced by a panicked crowd. The intellectual victory here is sharper than the financial gain. It is the proof that discipline beats emotion every single time. The graveyard is gone, replaced by a landscape of growth. The lesson is not just about this single trade. It is about the process of sifting. When the market bleeds, most see only the red on their screens. You must see the structure beneath the noise. Sifting through the debris requires a cold, mechanical detachment from the crowd. It demands that you ignore the panic, isolate the essential, and wait for the mispricing to reach its peak. This is not a static skill. The market will cycle again, the fear will return, and the exits will be crowded once more. When that happens, do not look for the graveyard. Look for the value that remains standing in the rubble. Keep your focus on the sticky models, the recurring revenue, and the fundamentals that do not break under pressure. The debris is always there. The next opportunity is already forming in the shadows. Be ready to act when the rest of the world is still running away. The market rewards the prepared.